Hey, everybody. So I just want to take a quick moment to chat a bit about inflation. I just came from voting a short while ago and on the news, hearing a lot of commentary that the economy and more specifically inflation is central to a lot of the decision making on election day. So wanted to take a moment to kind of step through how we've gotten to this situation with respect to inflation and on balance, who is responsible for it. So to tell this story properly, I think it's important to backtrack really something on the order of almost 20 years um, to kind of speak to the rate environment, the interest rate environment that the Federal Reserve has had in effect within America. If you wanted to, you could even go all the way back to the Greenspan era. But it has been an overarching policy position of the Fed that we want 2% inflation and we want to um, try to use the monetary tools of the Fed to keep investment in America going. And so the preference is to keep rates very low so that, and again, what a federal funds rate is the rate at which the Fed, the federal government, the Federal Reserve Bank, is lending money to banks across the country, who in turn lend that money out to consumers. And so we had lived in a very low rate environment for many years. You're hearing now about in the 1970s when federal funds rates approached 20%. Obviously, the rate environment we've experienced for the last couple of decades has gotten nowhere even close to that figure. In fact, we spent a lengthy amount of time at a 0% federal funds rate, or 0 to 1/4 point technically. And so in brief, we've had this very strong economic expansion with a few blips along the way, most notably the 2008 crisis. And after 2008 crisis, we've had extraordinarily low 0% interest rates for a significant amount of that time. And heading into late 2019, early 2020, we had actually seen our rates start inching up because we were noticing that, wow, this economy is quite heated. There had been a fair amount of pressure from President Trump to keep rates down because it is certainly a positive for the stock market when rates are low, investment is very cheap. And that's when COVID hit. So we had started dialing up rates a bit. COVID hits, and the world shuts down. We all experienced it in early 2020. This exogenous event, the arrival of a sickness that nobody quite knows how to manage. You saw some very scary images across Europe, China, as it approached the United States. We weren't really sure what we were in for. And to the credit of the government at that time, we kicked into gear right away. And we passed a lot of stimulus to keep the suppliers of key goods up and running when demand had really fallen off. And then additionally, when we're keeping folks at home while we figure out what this sickness is all about, the government is sending out stimulus checks to compensate for the fact that those folks are losing their income or otherwise would be losing their income should companies be looking at the situation ahead of them and saying, like, look, we got to lay people off. I mean, PPP, for all intents and purposes, was the government saying, rather than everybody sign up for unemployment overnight, we're just going to send the checks to the companies so the companies keep their doors open. They pay their own people. It's just, frankly, an easier way to manage the administrative burden and not displace tons and tons of workers. So all of that, I think, was smart policy. In conjunction with that, the rates that we were talking about a few moments ago, they went straight to zero again. And that is questionable. There was obviously thinking in that moment. And it's hard to fault anybody for it. But the thinking was, we need to do everything we can do to keep this economy on track. But as you think about what happens in low rate environments, again, it's a mechanism to facilitate lending from banks. You want liquidity in that market. The number of people taking out loans from banks that were not PPP loans, fairly limited. It was a very challenging environment to be making significant capital investments. So not convinced a whole lot of those actually happened. What did happen, however, were lots of refinances of homes and lots of loans for new mortgages as people decided, hey, I don't want to be in a crowded city when nobody's going into the office for fear of the spread of a virus. And so we experienced and have continued to experience still very recently a major asset bubble in our real estate market. And we also experienced something of a bubble in our capital markets as well, where we saw stocks have an extraordinary run up. And some of those stocks were of the most risky, least profitable variety. You are probably acutely aware of the wide number of unprofitable tech companies that nevertheless rose to extraordinarily high valuations. Multiples for certain companies reach 90 times revenues or even higher than that in a few cases, which is absurd when you think about kind of historical multiples on revenue for lots of legacy companies on the order of 1x. So really, really crazy distortions, and perhaps best manifested in the cryptocurrency market, where tokens to participate in these digital economies had unbelievable run-ups, and that didn't even have any actual connectivity to underlying cash flows, right? Like if you bought a cryptocurrency token, you were purely making a bet on the fact that this is a new digital economy. It's going to exist in this kind of metaverse domain, which is not terrestrial, but hey, just like the economy of the US is this big, and the economy of China is this big, and the economy of the UK is this big, the economy of Bitcoin is going to be this big. There's only going to be so much currency that ever exchanges hands in that market. I should grab a hold of some of that. It's a little bit like if somebody started a Monopoly game and you start out and you say, hey, we got 10 grand in the kitty, and that's all we're ever going to have. You invited some friends to go ahead and play in the first game. You asked for a real buy-in of actual US dollars. And from that point forward, everybody just got to keep the Monopoly money. And if you ever wanted to play the game of Monopoly, well, you had to buy it off the hands of whoever came in. And if a whole bunch of people at the very beginning said, well, you know what, it might be a good idea if we made the buy-in 10 grand, but you keep the Monopoly money afterwards, and then you can sell it to other folks, you can see how there could be a very interesting run-up, particularly if you had other friends that you're kind of cutting in on the deal and so on and so forth. That's how a lot of the altcoins of the most shady variety built a name. I think there's a strong argument for certain cryptocurrencies of a more legitimate type, but a lot of these kind of sketchy rug pull variety gained fame, gained notoriety during this period because there was such extraordinary risk taking when the cost of taking out a loan was so very, very low. So we've got this extremely low rate environment. We've got a lot of stimulus being sent out under the Trump administration, which was bipartisan supported as well. I think by and large it was good policy. I think the rates are the real question mark here. And at some point, the Fed realized, hey, we're going to need to start raising rates because we are experiencing a superheated real estate market. We're seeing these secondary markets where folks are leaving New York, leaving LA, leaving San Francisco, and investing huge amounts of money in places like Boise or mountain resorts in Colorado or Utah or wherever, because or Florida certainly is another case example here, um, because the cost relative to what they were used to was relatively low, and there was no telling how long the pandemic lifestyle would last. Um, so signaling started at the end of 2021. Hey, we're going to go ahead and raise rates. Be aware of that. We don't want to spook the markets, but we're going to be raising rates. They telegraphed this. They telegraphed it for a very long time. And it wasn't until the beginning of 2022 when rates actually started going up. Arguably a fair bit later than they should have. And it was not more than, literally within weeks of each other, we have Putin launching his war in Ukraine. And so, what does this do from an inflationary standpoint? Well, we'd already mucked up supply chains during COVID. I mean, like, despite all the stimulus we talked about, the fact of the matter is, different factories around the planet got shuttered. Companies stateside who wanted to buy goods were unclear on whether or not their suppliers are going to be able to deliver. So they're buying double, triple orders. We've heard a lot about chips, how chips couldn't be delivered. We had all these cars sitting on the lot just coming off the factory line, but they couldn't actually be operationalized because they didn't have chips. A whole bunch of crazy stuff happened in the supply chain because of COVID. And then we add on to that this war in Ukraine. Ukraine turns out to be, it's the breadbasket of Europe. And on top of that, there's a lot of other industries impacted by this, and then related sanctions on Russia, which would seem to be an appropriate action when you think about invading another country's sovereignty. That also takes a lot of Russian economic output off the market. Now, Russia is only a few percent of the global economy. However, it punches above its weight class when it comes to oil and gas. And for that reason, we've seen a run up on oil and gas prices. And that was obviously compounded by the fact that we're at a moment in history when, by and large, Americans and people around the world feel that we should be transitioning to green energy. Now, the fact of the matter is we continue to drill a significant amount of oil and gas. That hasn't shut down. But what has broadly drawn to a close is reinvestment in refinement capacity. As people are looking, as oil and gas execs are looking at the future, they're saying, where should we be investing our money? Should we be investing it in things like renewables? It seems like that's going to be coming online here soon. Or should we be investing in new refineries? Recognizing that the payback period for a refinery should be over the course of decidedly more than a few years. Especially when you consider that they just come out of, during COVID, the price of oil dropping down below $30 a barrel. I mean, it was crazy. The demand just fell off entirely, and then this glut of oil existed, driving down the price. So in response to that, naturally, oil and gas execs don't want to invest further in particularly new major refineries. And that is currently the bottleneck in our market. So what has been the response? The Biden administration, which is now in office, they try and drive down the price of oil with the Strategic Petroleum Reserve. There's some question whether or not that is prudent or not. Fact of the matter is we have a reserve for when there are threats to our energy situation, when there are shortages. So arguably, this is a time to deploy it, so long as you're in a good position to replenish it with more oil and gas. And that remains the question, because that may be an expensive endeavor here if the prices stay high. That being said, it's hard to tell exactly what the outcome would have been had these draws from the Strategic Petroleum Reserve not done. And we've seen how runs on assets can take place. Along the while here, too, we should note that the Biden administration invested $1.9 trillion in another round of stimulus, bringing the total to around $7 trillion of stimulus, 5 from Trump, approximately 2 then from the Biden administration in the middle of 2021. Was that needed? Again, it's that one is again a question mark. Is it inherently bad? Truthfully, for the problems we face, it's hard to say definitively. It's the rate environment, frankly, that has been driving asset bubbles and creating this inflation issue. Although it cannot be fully disregarded that, hey, we're printing an awful lot of American dollars, and that does have an inflationary impact. There's just no two ways about it. So there's definitely a key impact there. So anyway, fast forward to now. Over the course of the last 8 months, we have seen a very maybe predictable outcome to what happens when you got to cool down inflation that is tracking at 8% when you've got a federal funds rate of 0. The choice of the Fed has been to gradually try and run up the Fed funds rate. We've now just gotten around 4% with a terminal rate expected on the order of 5%. Some recent signaling from the Fed that maybe it goes higher than that, but the rate at which it's going to get there, which, the rate was a historically fast rate, but even still, it has allowed for inflation to persist, because what we've seen is throughout the course of this year, the signaling of higher rates supported ongoing buying in the beginning of the year, where people said, oh crap, I better get in before it's too expensive to get a mortgage. And it's just in these last few months where you've actually seen a real correction in housing prices, which has corresponded to with the demand to get workers back in the office. And now we're starting to see goods inflation go away as well. What's proving to be sticky are wages, right? The reality is that coming out of the pandemic, people have wanted to spend money on experiences. They spent their time locked up in their homes, spending money on all kinds of goods, right? They had forced saving by the government. You can't go out, you can't spend stuff at bars and restaurants and on trips. What you need to do is you need to stay at home. And so people goosed, frankly, the revenue story for companies like Amazon, buying everything that they might want to make their life at home better, in addition to actually buying new homes. Now we're seeing that transition where everybody wants to live again. And as they live again, as they go to concerts, as they go to restaurants, as they go to bars, as they go on trips, all of that has inflationary impacts, because all of the frontline workers that exist in all those industries, many of them went away during the pandemic. Now they're coming back, and they're coming back to an environment in which they're in extraordinarily high demand. That then drives higher prices, higher wages to get those people back to fulfill the demand that is seemingly insatiable and maybe only now starting to show cracks. Again, as interest rates have gone so far up, and correspondingly the stock market has come so far down, that people are just now, we're really starting to see some meaningful behavior changes. So on balance, like, where does that get us today? Well, right now we're in a moment where the stock market has adjusted significantly. Inflation on goods has started to stabilize. On real estate, it's actually started to come down a bit on a month-over-month basis, but still significantly higher than last year. And on services, we're still seeing hot numbers. Even when you throw out things like energy and food, which really are not things controlled by the Fed, but nevertheless very much impact people's pocketbooks, we're still seeing core inflation at elevated levels. And obviously, when it comes to food and energy, we're also seeing those at inflated levels because of, as we mentioned, some of the impacts of the Putin war in Ukraine. So where does blame lie? Well, as folks are casting their ballots right now, the number one thing is COVID. I mean, you just have to look at that situation as a very weird externality, which led to a whole lot of stimulus from both the Trump and Biden administrations, as well as crazy snags and crazy purchasing behavior tied to our supply chains that we just haven't seen anything like it, right? Certainly not. I mean, you have to go back to 1918 and the Spanish flu to think about a global pandemic. And in that world, we just didn't have the same connectivity, interdependence of economies, and trade that we do now. So just a really wild circumstance. The first prize in this contest goes to the coronavirus. In second place, I think, is the Fed. The Fed, it did what it thought it needed to do in the face of an extraordinary rare event, which was COVID, and that was to drop rates down. But what that has done was created asset bubbles in the stock market and the real estate market. And really, that is not something that was probably net beneficial to the country, right? You're just stealing returns from the future, and at some point you got to pay the piper. And right now, that is what's the debt is coming due here, and I think we're really going to feel it in 2023. In third place, I think Putin deserves credit. I think that the Russia war has really created a new exogenous event right when we were starting to get our policy to a better place. And then I think that, Biden and Trump both deserve some responsibility, but I think that they're coming in fourth place here. I don't disagree with the stimulus moves by Trump. I slightly disagree with the Biden stimulus. I do think, though, that on balance, the Biden stimulus, I think you really kind of have a fog to consider around that. And, we weren't out of the woods yet. And the way that money was allocated arguably was judicious. I think that some of the PPP money and whatnot that came through some of those programs, again, hard not to give a lot of free passes in such an odd time, that you did see abuse of that system. Last but not least, it's the and part of the reason why you got to give Trump and Biden credit, I think, too, economy's been really strong, and that leads us to our last point. It's the American consumer that deserves some responsibility for this, and it's hard to blame anybody out there for making money and spending money, but the fact of the matter is the American economy has done very well. We've got crazy low unemployment at 3.5%. We haven't seen that since the 1960s, and that moved down during Trump and went down further during Biden. That means that we're in this space where people are willing to spend, and that's what helped contribute to some of the goods inflation. That's what continuing to contribute to wage inflation, particularly in a lot of the frontline jobs, like I said, that are related to their service economy. The United States is a 70%, nearly 70% services economy. We can't escape from that reality that until wage growth gets solved, you're going to see high inflation numbers, and then combine that with what Putin's done and the natural cycle as it relates to oil and gas investment in this kind of unique moment in history where everybody kind of recognizes we need to transition to green energy. It's made it so that oil and gas companies overwhelmingly are happy to pay out great dividends. And if the price of oil is really high or if it's really low, they're going to keep pumping, and some years are going to be boom years, and these are those years, and some are going to be lean years. And right after the pandemic hit, that was a lean year. So, a lot of guilt to go around. But if we're going to hand out prizes, I think that's the order. So that's our take on inflation in a nutshell. If you're interested in seeing analyses like these, don't hesitate to reach out. follow us as a company for one. And if you'd like some kind of personalized insights, don't hesitate to reach out to us at Bulkery.